Hi, I'm Chuck Inglefield, founder of Inglefield Retirement Solutions, and this is my economic update for the third quarter of 2025. For those of you who don't want to watch the whole video, I've put together a quick summary of the topics I'm going to address. The first is that the economy grew at a 3% rate. That's up from a negative 0.5% rate in the first quarter, so that was positive news. The Fed held interest rates steady for now, but because we're starting to see some cracks in the labor market, there's an expectation that they'll drop rates at some point this fall. The markets definitely have rallied, but if the economy does show signs of slowing, which sometimes the job market indicates that could be the case, then the Fed might have waited too long and we might see more volatility in the markets. And finally, tax and tariff reform are still driving a lot of what's going on in the economy. I'll be providing some detail and color around these topics. You can look at the timeline to find the subchapters if you want to just jump ahead. One thing I want to start with here is the tax policy, but I pulled out some of the things that I think really impact retirees. There's a senior bonus deduction, at least through 2028, where individuals or married couples will get an additional deduction on their taxes. There's been an enhancement on the standard deduction, so that's increased. Both of those things could indirectly impact taxation of your Social Security. So the estimates are that the bill doesn't specifically eliminate taxes on Social Security. Those stacked deductions may effectively shield up to 88% of seniors from paying income tax on the Social Security. There's an auto loan interest deduction for American-made vehicles or American assembled vehicles. Not sure what qualifies under that, but that can be a positive. And there is a twist that may come in the future where there might be RMDs required on Roth accounts, which is not something that we have seen in the past. So we'll have to keep an eye out for that. But in general, this is definitely a pro-growth tax bill. And when we put that together with the tariff policy, which is inflationary and anti-growth, it puts the Federal Reserve in a pretty tough position because they're trying to balance full employment and fighting inflation. And let's take a look at just specifically what the tariff policy is, since that is the anti-growth portion of this discussion. So the tariffs right now, as proposed as of August 1st, and of course these are always changing, the full tariff amount would be 16.3%, which takes us back to where we were in the 1930s. But we have not seen the impact of these tariffs yet because a lot of them have not been implemented. So the effective tariff rate so far in 2025 has only been 4.7%. So the inflationary aspect of tariffs really isn't kicking in quite yet. And also, if prices go up, consumers tend to buy less. And so we're going to see a slowdown in consumer spending, which means a slowdown in GDP, hopefully not so much that we see a recession. And you compare the pro-growth tax bill and the anti-growth tariff policies, and where does that put you? If you're the Fed, it puts you in a pretty tough spot. And we saw that here at the end of July, the very last week of July, the Fed announced their rate decision, which is they're going to hold interest rates steady for now. And we see this on this chart here. The green line or gray line, for those of us colorblind, we really can't tell, is holding steady at 4.38%. You can see this on the far right side of this slide. And they made that decision in one of the more fascinating economic weeks in quite a while. So the last week of July, there were three key things that happened. On Monday, we got the GDP numbers, which again, we saw 3% GDP growth in the second quarter in the economy. So we saw that on Monday. Then the Fed made their decision on Wednesday to hold rates steady because they said, okay, if economic growth is still okay, we still want to have a chance to fight any inflation that might come from the tariffs. So that's what they did. They held rates steady. Then on Friday, we got the jobs numbers released, and they showed some meaningful weakness, not only for the month, they missed estimates by quite a bit. The two prior months were revised downward where not nearly as many jobs were created as expected. So we are seeing weakness in the job market. In fact, this next slide really shows some of the labor market flows. You can see the dark blue line is the job openings rate. It's been coming down considerably. in the last couple of years. The hires rate is leveling off, but still lower than where it was a few years ago. And the quits rate is decreasing, meaning people aren't quitting their job because they're not confident they can go out and find another job. So the labor markets tend to be a lagging statistic. And that might be troublesome because the labor market is telling us, hey, the economy is slowing down, but we're already possibly into that slowdown by the time the labor markets tell us that. So you get this again at a time where the tax policy was just passed, and that's pro-growth. So the question is, are we headed into a recession? And for those of you who are regular visitors or watchers of this quarterly economic update, my favorite indicators here are the purchasing managers indicators. If that blue line is below 50, it indicates that manufacturing businesses are contracting. The market activity or the economic activity for manufacturing is contracting. And you can see in July, we're at 48. We've been hovering around that 50 line for quite some time. We haven't dropped meaningfully below it like you can see in 2020 that we did. And of course, back in the Great Recession of 08, 09, but we're not confidently above it in expansion. We're also not confidently below it in contraction. Pretty much tells us where we were with the economic releases this week. GDP looked okay. Jobs didn't look good. All right, so let's look at the 4/5 of the economy, non-manufacturing or services, came in at 50.8. So it is slightly above 50. So I would say that's expansion area, but not convincingly. So we're at a bit of an inflection point, and I think this is going to be something we're going to be looking at over the next quarter. The Fed's definitely looking at it. They'll meet again in September where they'll make a rate decision. What's interesting is on Wednesday, when they made their decision to hold rates steady, the bond market was pricing in a 50% chance of a rate drop in September. After the jobs report on Friday, the bond market is now pricing in an 80% chance of a rate drop in September. So quite a bit of a shift in just 2 days' time. And again, the idea is if the Fed lowers interest rates, that's good for the economy. It helps spur economic growth. The question is, should they have already done it? And we'll know that in the next few months, most likely. So what does all this mean for us as investors? Let's start with the stock market. Valuations on stocks are elevated, to be sure. We're setting new stock market highs pretty consistently all year long. And so when we look at this chart, it shows that the forward PE ratio is 21.8. The 30-year average is 17. So when you get above that +1 standard deviation line there at the top, it means that things are a bit overvalued or priced somewhat for perfection. Is this a problem? It could be, but it might not be. And the reason I say that is, at the end of the day, corporate earnings are really what drives stock prices. And if corporate earnings are healthy, you can justify higher valuations. This earnings season, 80% of the companies have beat their estimates. So that's definitely a positive that might justify these higher valuations. The other thing that comes into play is what are earnings expected to do over the next few years? And this chart really shows us this. The bar chart on the left, you can see that earnings are expected to grow 13% in 2026 and again in 2027. So if that happens, that really can justify higher valuations. One of the things that's harder to measure for what might happen in the next few years is productivity improvements really affect profits or the bottom line. And you can see that S&P 500 profit margins have been pretty healthy for the last few years. And there's expected to be more efficiency gains as corporations implement AI into their businesses. And so that should increase productivity and it can provide a profit boost. So again, these are the things that I think are going into some of those higher valuations we're seeing at the moment. But what do higher valuations mean? It means that if there are some misses on earnings or you start to see convincing signs that you might be going into a recession, you're going to see more volatility in stock prices. The stock market's actually a really good leading indicator with regard to economic slowdowns. The stock market tends to drop about 6 months before the recession actually is declared. The stock market right now is saying, hey, there's no slowdown on the horizon. bears watching. I'm sure we'll be talking about this in the next quarter. What are some of the positives? Markets like lower interest rates. And so we're potentially moving into that environment starting in September, if not even sooner. The market likes the tax incentives, the tax policy that was just passed. And again, there might be a productivity tailwind with AI. So those are all things that are impacting where equities might be headed from here. So even though we've talked about the potential for an economic slowdown, possibly even a recession, there are obviously some things out here that could be a tailwind for the economy, and we'll just have to see how things evolve. The one thing that remains the same and always will is that fundamentals always matter. The key is just own quality investments and align those with your plan, the asset allocation being very important part of that. In fact, a good example this year is that although U.S. stocks are up 8 or 9%, depending on the day you're measuring at this point in early August, international investments in your portfolio are up over 20%. That diversification among those asset classes is helping us tremendously this year. And then finally, we just rebalance so we're never taking any more risk than we intend to with our plan. So thank you for your time and attention this quarter. And if things come up in between now and the next quarterly economic update, I'll probably produce a short video. I hope you have a great rest of your summer.